It's Bruce here, Uncle Bruce here. Stock markets with Bruce, Palm Desert, California. How you doing? Life is good here. I tell you, I kind of like it here. I've always liked it here. Welcome one, welcome all to this morning's show. We're going to follow the markets and see what's going on. I hope you're having a good day out there. We're going to have an update this morning. Oh, yeah, we're going to have an update. We had an update yesterday, even after a disastrous start. We had a lousy start in the market yesterday morning. Well, in the morning yesterday, down about 400 points on the Dow at one point with a 110 point eventual gain on the day. So that was a 500 point swing from low to high. I kind of suspected that might happen because we just didn't get the selling volume that tells me we're into any kind of a serious sell-off. We just aren't getting it. We've got investment entities out there desperate to find a return for their capital, and they're just receiving so much capital. Institutional investors like pension funds, mutual funds, ETFs. Pension funds get automatic deposits from employees every month, every 2 weeks. Mutual funds have set up with banks and other institutions automatic monthly installment plans from investors, and so these entities are getting cash every month with which to invest. On top of everything else, the dividends that a lot of these mutual funds receive are just reinvested back into the funds themselves. In effect, the money comes in and they just have to plow it back into a proportionate amount of stock, depending on which stocks are falling. If you're bearish on a stock and have shares for writing calls, does it make sense to write calls that are deep in the money with the expiration drop below the start? It could be. In theory, if you think a stock is going down, you don't want to give it up though. So you're sitting on GameStop. You're sitting on GameStop shares and you think they might go to 150, you can write 150 calls. Write 150s for a month out, 2 months out. Get the premium, the book value plus a fat premium, maybe $40 a share, something like that. If the shares go to 160, they don't even reach 150, but they go back to 160, those 40s will go to $20. Score the $20 on a $10 drop, make 20. Can be done. It's up to you. Only cover call I haven't bought back is Rklb. 1750 for next Friday. Should I wait for it to get closer or take advantage of the movement and time to roll over into November for a small net credit? There's a good question. You're still out of the money, so there's no hurry yet. 1584, 1585. It's at the new high of the day right now, but it's not in the money. Look, you can, you are in control here. You are the boss. I like the idea of waiting it out. 1590 though on Rklb. I'd wait it out. Dare the stock to take you out, or dare the stock to go to 17 between now and next Friday or tomorrow. If you have to do a rollover, wait for the shares to go higher and then do the rollover. I wouldn't budge right now. Looking good though. I'm about to start writing covered calls on Pfizer. Finally, are the dividend dates something I should consider when writing the calls, or do they not make a difference? Well, it depends on just how far out you're going to write the contract for. There's a temporary issue there. If you're writing a contract within 50 cents of the strike price, right at dividend time, that might have an effect. Just keep an eye on the chain, like the option chain, to see what these contracts are going for, depending on how long they are out for and so on. But if you're going to write, say, let's say you write a 1 month or 2 month contract, to get maximum premium in for an out of the money call, then it shouldn't really make much of a difference. What you'll do, of course, is you might find, for example, that you write a contract for, let's say you write one for $2.50. I'm just picking a number. Say you write one for $2.50. You write a bunch of them. and they're good for two or 3 months, and then a month in or so, an announcement is made on the dividend of the company, the shares, and a record date is announced. That may or may not move the market at all, and it may or may not move your options at all. Then maybe 3 weeks goes by, 4 weeks goes by, and the record date comes and goes. So that means anyone who owns the stock now doesn't get the dividend versus someone who bought it yesterday. You may find that the stocks drop 30, 40 cents a share on that day, on that next day, which is good for your contracts because it brings them down in value because the stock went down in value. That might be possibly the moment you strike, you make your move to buy back the very contracts you've written at a higher price at a much lower price. That could be it. But on the other hand, that might not be it at all. You might be simply buying and selling the contracts, writing and buying them back simply because they are depreciating in value, crapping out, which is what your strategy is. You're finding that writing a 5-week contract or a 4-week contract or a 7-week contract, whatever the one, whatever the timing is, at a set price above the market is the perfect one to write for you. Gives you the most comfortable vibe, and you're looking for depreciation of the contract. You're just looking for time depreciation to be your friend. So if you're writing a 2 month or 3 month or 4 month contract, great. If it's a 2 week, 3 week, 4 week, great. Check it out accordingly and figure it out. But you're on the right track, man. You're back. You're here. This is good stuff. What number will be a good time to write Matterport covered calls? Do you think, Uncle B? Well, if the shares reach 20 today and they just kind of hover there, that's one thing. But if the shares get to $20 a share, then back off to 1950, and then go to 21, that might be a point to sit back and go, hold it a second. We are really catching some drift here. Let's let this thing keep going. Tomorrow she might go 22, 23. Which is the high of a week or two ago, and you might be up at that point. You might be at that point in the position to say, I think I'm going to write 22.50s or $25 calls. But we're going to have to wait and see how this stock gets to 20, through 20, and beyond 20 to tell us what contracts to write. The stock will help tell us which ones to write. It really will. It will help you. But you're going to have to allow the stock a little bit of time to give you the sense of direction that you're kind of looking for, okay? Do you still like the Spire February puts sitting at $13.70, $20 strike? So $20 strikes, $13.70. I'm not a fan of that, I don't think, because you take the $13.70 off the $20 price, and you're on the hook to buy it at $6.30 a share, and the stock's at $6.26. There's absolutely no premium in this trade. Not a fan of that deal. Not a fan of that deal at all, Cheryl. You need upside. If you can write a put on Spire, where you can buy the stock for less than $5 net to you, that might be the contract to consider writing. You're gonna have to shop around on that option chain to see which contracts can give you the best deal. Just take the premium you're getting from the exercise price, and that tells you how much you need to cough up for this deal. This one here, 1370, is not. There's nothing in it. There's no upside for you at all. That'd be my take on it. Folks, check out stockmarkersbruce.ca, catch a lesson 2 or 3 or 4 or 10, and become a little smarter than others. You only need to be smarter than half of the market players.